All right.
Good morning, Pete.
Good morning, Don. Don Vivrette has been a volunteer with our financial and estate literacy now almost going on 10 years, or is it that
Seems like a
long?
lifetime, Pete.
And is also our charitable consultant, and he's a CPA, but doesn't practice in accounting, so or in taxes. He's allowed us to put this program together, and I want to thank you for that, Don. I really appreciate it. We have a board of directors, and one of the two main things that we do to educate you is the It's Your Money and the It's Your Estate program. Our first speaker today is Delia Fernandez.
Hang on a minute. First of all, we need to do an introduction here. So let me do that. So I'm going to bring that up and make sure that I get this right. That one. Yes. There we go. Okay. As we said, finance and estate literacy. This is It's Your Money for the fall of 2022. This is week 1, which is more of an overview than other parts. There's a handbook. If you go to the website, and I'll show you where the website is located, there is the presentation material for each day, the Ask First form for each week, not day, and then there's also a workbook. We put it in last sessions and have updated it somewhat just in terms of grammatic errors that I made. It is not intended to be a product that you need to complete as a part of this. There's no exam. You're not going to turn it in at the end. It is simply a thought provoker in terms of goals, objectives, assumptions, and things like that as we go through it. Really, the questions a lot of times that we get into, especially in It's Your Money, where are you today? Where do you think you're going to be tomorrow? And what are you going to do to try to get there as you go through it? As a great philosopher, map out your future, but do it in pencil. The road ahead, as long as you make it worth the trip. So that's a thought for us. This is just a picture of the cover and the table of contents in terms of the material. They follow each of the 6 weeks as we go through it. And there's the website. And it would also be on the announcements you're getting each week in terms of the meetings. And as I say, there you go. Your homework, in a sense, is to go through and think about what all we're talking about and plan for yourself, because this really is for you. And that's the important part. So.
Yeah. Nobody's benefiting from this workshop series financially. So
yes, the participants will.
The participants will. You, the attendee, the watcher.
Yes. Now, incidentally, it's because I'm monitoring Q&A. My last name is Vivrette. So I'm Don Vivrette, and here's what we're doing. And Pete, I'm going to let you take it from here, and off you go. I'm going to be in the distance and monitoring Q&A, and so I will appear occasionally when there are questions.
Okay. Delia, come on screen.
Hello.
Hello, Delia. Good to see you again.
See you.
Your days of NPR and Larry Mantle, your status in the financial world has just really increased. The reason why I'm saying this is that Delia and I started the first It's Your Money program at Long Beach State University about 24 years ago.
Pretty amazing.
Yeah, it is. And here we are today. We're still going at it. We have what's called the Ask First form. And the reason why we have that form on our website, when we encourage you to take a look at it, is that the number one reason why people choose their financial advisor is because they like them. And that's really important, that you like your financial advisor, but you need to know a little bit more about them. And we're going to learn a little bit more about Delia as well. Delia, you're a fee-only fiduciary advisor, is that correct?
That's exactly it. I've always been fee only.
Fee only, and we're going to get that in your in the first presentation, or should we go into a little bit more detail?
No, it's up to you, however you want to do it.
Okay, let's go on for now. How do you charge your clients?
I charge either for hourly financial advice or ongoing assets under management.
So-
And a lot of people, I like to do planning first anyway, even if they're sure they want to do assets under management.
So I give you $500,000 today for you to manage. How would you charge me?
It would be 1% a year, charged quarterly at the end of the quarter after I do the work.
So it would cost me $5,000, but not upfront. It
That's
would be
correct.
On a quarterly basis. Do you charge for phone calls, for emails, for none of that?
No, I like to say that if I were doing hourly work with a client and we've done a plan and they call or email, unless they're going to put me to a lot of work, I just answer the questions.
And
If they say, can we rerun the plan this way and this way, then I'm like, well, it might take half an hour. Can I charge you X?
yeah, what I find a lot of people view you as a financial planner more just concerned about investments. Do you answer people's questions about their insurance, about what kind of retirement to take, whether or not to give money to their children? Do you address those kinds of issues?
Absolutely. I consider them really critical before we know how we can invest your money. We need to know the purpose of the money and how the rest of your finances are doing.
Okay.
So I can't invest your money if I learn that you've got 45,000 on credit cards that you can't pay off. I mean, I can't sleep at night. It's not proper to invest your money if you have debt that you can't pay off. That's really egregious, awful, terrible interest rate debt. So we have to figure out what your financial condition is first,
Okay.
and then we can invest your money.
Before we get into your outline that you prepared, you mentioned sleeping well at night. And, right now, I think for the past 3 months, 4 months, 5 months, the market has just been going down, down, down. And I'm assuming that people are starting to get concerned. And is this a new type of environment?
No,
And I want to get your comment on that first, of what's going on in the world, and should people be panicking?
Yeah, I don't think that they should be panicking. It's not new. And if you do panic, then you're going to miss some of the best times in the market. So let me show you, if I may. Here's just a chart that shows what happens if you miss some of the best days of the market. So this is from Fidelity. This is from Fidelity, and it shows that market timing can be costly. So
market timing means that you right now, hey, the news is bad, I'm going to pull all my money out of the market.
That's right. And you do it just at the wrong time.
Okay.
I mean, it's almost a truism among the financial community that if you know that particular client who's always worrying and they call you and say, sell, 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 maybe we should all buy, because maybe we've hit the bottom of the market. I mean, it's a little cruel, but sometimes people just hold on until the last minute. They can't stand it, they sell, and that's when the market rebounds. And you are never going to know.
So tell us what this chart means.
So this chart says that here you have $10,000 in the Standard & Poor's 500 mutual fund or index fund from January 1st of 1980 to June 30th of 2022. And if you had been invested the whole time from January 1st of 1980 through the end of June this year, you would have $1,060,000. But if you had decided to try to time the market and wound up missing the best 5 days of the market, you would have only $655,981. I mean,
That's almost incomprehensible.
It really is. It really is.
I mean,
You'd have almost half as much.
yeah.
And then if you miss 10 of those best days, you'd be down another huge peg. I imagine somebody just going down several floors. I mean, you'd only have 472,481. And if you decided to sit it out a month, which some people will tell me, well, I can't stand it, I've got to wait a month and then it's going to be better. You would have only had $171,261. And then you missed the best 50 days. And yeah, well, you made 7 times your money, but this is pitiful. I mean, this is pitiful.
So when you begin, is this a reason why you really need to spend time on the front end to begin the planning process?
Yes, you do. And we always like to say too, because the majority of us do not consider ourselves market timers. It's time in the market. It's not timing the market. So you need to know how much money you need to put aside for the longer term. And if you have the time to invest, then you will have the time for your money to grow. You know, I was telling Dawn that if a 30-year-old came in and said, I just got this whole big pot of money, I want to go for it, I'd say, yeah. And if I had a 67-year-old who's really close to retirement, they're saying, I'm thinking of putting 100% in the stock market, I'm like, wait, you know, how much of this is you're going to need for retirement income? When are you going to need it? How much do you need for other things? How much are you going to need to pull out the first year or two of retirement? Let's make sure that we strategize how this money should be tiered, how it should be scheduled, so that we know when you're going to need the money and how long we can afford to actually invest it.
Is that one of the hardest things to do as a financial planner, is to develop a strategy to make sure that your clients' risk ability is accurate?
Yes, yes. And a lot of times the client doesn't really know, because in good times they'll say, well, I have great risk tolerance, of course. And in bad times they'll have zero risk tolerance. But in the meantime, I need to look at their finances and know, and this is a secret, most people do not know what it costs them to live. This is not a quiz. You guys out there don't have to write in and tell me what the answer is. But for a planner to schedule out how much money you're going to need, we need to know how much you spend.
Yeah.
And how much maybe you spend now and how much you're going to need to spend later. You have some plans later that are going to be more expensive than what you need today.
Yeah.
What are those numbers? So you need to know your numbers, and it's your money. We need to know this.
Yeah. Well, this is the overview, so it's a great beginning. Let's go to your outline.
Yes, let's go take a look at that. Let me go pull it up. Okay. Let me share. Let me make sure that it is big screen. Let me then set up for big slide.
And that's to remind everybody that the outline is available on our website, IYME, and you can download it and also get Delia's Ask First form as well, along with other articles that we put on there that we think, well, you may, that might be pertinent to you. So,
sure. And that handout will have information on where I am.
Good.
So we want to cover the regulation of the investment industry. Pete, I know how big you are on that.
Yeah, it's just, it's convoluted and it's hard to understand, but we're going to give it a try.
And we're just going to touch on the financial planning process because you're going to have sessions on that later.
Yeah.
And then
but you're going to go through and just explain it.
Absolutely.
Okay.
Absolutely. And then what's new in taxes for 2022?
Yeah, this is a 6-part series. So Delia could do every single part in the entire 6 weeks, but we want to introduce you to some other financial advisors as well.
Oh, yeah. Great. You got a great team. Pete always has a great team of advisors because I know them all. Okay, so financial advisors and planners, this is a huge category of general terminology, but really we kind of fall into 2 camps. We are either independent, we work on our own, or we're associated with a brokerage firm who we call a broker dealer. Think of it as an escrow agent for the investment world. They stand between the buyer and the seller. They're a go-between. And so the broker dealer person is a registered representative at the brokerage firm.
So a Merrill Lynch, a UBS, LPL,
Sure.
These are brokerage firms.
Those are brokerage firms. Those
Sometimes called wirehouses.
sometimes they'll, you know, one of our old terms from forever was wirehouses because they had a direct wire into the stock exchange.
Yes.
Old days.
Yeah.
We all get compensated in different ways. Typically on the brokerage side, you will see commission, maybe fee plus, maybe fee offset. You may hear them call themselves fee-based. The lines are getting a little fuzzy because of the terminology. And then we have fee-only advisors. So we need to break this down a little bit more.
By the way, we only have fee-only advisors as presenters. We do not work with any fee-based, fee offset, or commissioned advisors in our program or in my professional life as a fiduciary. We do not work with brokers. And there may be good brokers out there, but it's very difficult to tell. We only do fee only, and the reason is that we paid a fee and we're only obligated to the planner.
And the planner is only obligated to the client,
Yeah.
which is the way we like it. When we choose this kind of business, that's the way we like it. So we have different credentials. So if you are independently registered as an advisory firm or an advisor, you are considered a registered investment advisor, a registered investment advisory firm. So even though I'm a sole proprietor, my firm, which is a limited liability company, from my regulator's standpoint, is considered the registered investment advisory firm. I am an investment advisor representative of that RIA firm. Already too much jargon, you know?
Yeah, and, you know, you list it as a credential. It's really not a credential. It's a registration.
Yeah, it is. You're right. It shouldn't be under that subheading. You're
But that's
absolutely right.
okay. Yeah, it's got to
You
have an
caught me.
outline.
You caught me. It should be one up and then the credentials
Yeah,
should be one
exactly.
down.
It's a
Yes.
certified financial planner.
Yes, this is a designation from the Board of Financial Planning. We're all very proud of having the CFP designation. We took 8 classes. We took an exam. We worked 3 years under the supervision or attestation from another CFP that we did our work correctly. And in order to use this designation after our name, we have to take 15 hours of continuing ed units every year. And every 2 years, two hours of that has to be on the code of ethics for certified financial planners. So we're very proud of that. And it's becoming more and more a recognized designation worldwide. There are other designations. And in fact, I went out on a regulatory website and found that there were 9 pages of designations. Pete
100
always wants to know how many.
150 plus.
It's amazing.
And more come on board every day. And the reason for that is,
because it gives the advisor a look of credibility.
yeah,
And people with the CFP designation are more likely to attract clients who have money that they want to invest. And the client, the consumer, is trying to figure out who they can trust.
let's say I wanted to go to work for Edward Jones. It's a very conservative Midwestern kind of a brokerage firm. Would I have to have a CFP?
Not that I know of, no. You'd have to have the brokerage firm related, the trading related designations, which are licenses to trade stocks, and to trade bonds or mutual funds or annuities. But you would not have to have the certified financial planner designation. And in fact, some organizations, even if their employee has it, these organizations do not want their employee to use it because it infers that they could be held to a higher standard.
Yes. Liability is huge in this industry, and it is an industry, and mostly it's involved around the sale of products.
Exactly, because how do people get paid? If their clients don't pay them directly the way a fee-only planner gets paid, then they have to get paid some other way, and it's typically by selling a product.
Yeah.
So there are other designations like chartered financial consultant that came out of the insurance industry. A CFA, we have the highest praise and respect for. The CFA is somebody who's taken a series of 3 exams. It's kind of like, I liken it to the PhD of investing. And even if somebody's only passed 1 or 2 of them, I'm like, wow, I'm impressed.
Yeah, it's the CFA and the CFP are your 2 designations that any consumer should look for as far as investment advice. Right. I call the CFP a mile wide, and I call CFA a mile deep.
That's a good way of putting it. Yeah.
So,
Exactly.
but it's really important to have the experience.
The experience, and of course, you want to choose an advisor who, first of all, you ask them, do you deal with clients like me, with situations like mine? And do you feel like you have a rapport and a trust and that they understand what your situation is and you feel like you can work with them?
So being nice is important.
It is important, certainly. And I think a lot of us, I hope, when it comes to our money, that the antenna should go up. And we should be asking the kind of questions that you raise in this course, to make sure that you know who you're working with, that they're qualified, and that they always have your interests first and foremost, ahead of their own. That's what's critical.
Delia, do you have a slide on FINRA?
Yes, so let's go
Okay.
take a look. Here's our regulator. Regulators in the industry. So the Financial Industry Regulatory Authority, or FINRA, is a self-regulatory organization.
What does that mean?
Well, that means that it regulates itself.
So Merrill Lynch, UBS.
Yes, all the brokers.
They all regulate themselves.
Right, they all regulate themselves. And we all have a lot of trust in that. And then there's the Securities and Exchange Commission, which is at the federal level of government, and it regulates the overall industry and registered investment advisors who have more than 100 million of assets under management.
So FINRA, I think this is really important. Anyone who's in the financial services industry needs to be registered with FINRA. Is that correct?
Yeah, we all have some tangential relationship with FINRA, even if it's just to check in to make sure that they know we're here, and they coordinate fees and things.
So if I wanted to look you up, Delia, I would go to FINRA broker check.
Broker check. I think I have that on another slide, but you go to brokercheck.org. And in fact, we are all required to put that on the homepage of our website.
Right. And then that indicates whether or not someone has a disclosure, and a disclosure is not a positive thing.
No, well, you're going to have your routine documents. So a registered investment advisor is going to have a disclosure form called their Form ADV. Pretty routine. Where's their office? What are their hours? What's their history? What kind of work do they do? What do they charge?
Yeah.
But if you go to brokercheck.org and you find that a broker has some complaints lodged against them, that's very, very bad.
And that's called a disclosure.
And that's called a disclosure.
And so when you look up Delia Fernandez on FINRA website.
Yeah, you get my Form ADV.
Yeah, you get your Form ADV, which tells everything that there is to know about Delia's practice. The philosophy of the SEC is that if we give the consumer all the information available, then a rational consumer can make up their own mind as to what's best for them. I don't buy that. I think it's very difficult, but this is where to get the information. So go to FINRA, broker check. Delia goes, when you get to Delia, you go to the SEC portion of the website and the state.
Yeah, so I'm regulated because I have less than 100 million under management. I'm regulated by the state of California, their Department of Financial Protection and Innovation. They keep changing their name. But
approximately how many clients do you have, Delia?
For asset management, I probably have about 40 or 41 and about 45 million under management.
Okay.
Although if the market's not doing well today, it might be.
Okay.
All hurt.
Yeah. FINRA, broker check. Don't forget that. Look anyone up who says they're in the financial services business.
That's it.
Okay.
So, and then as you pointed out, you always want to make sure that you take a look at the Ask First form, or you use it as a model for when you talk to advisors.
Yeah. And to understand the difference between a credential and a license. A Series 7 license is what is required for most brokers to work in a brokerage firm. I guarantee you, if you're a reasonably intelligent individual, we can get you to pass that Series 7 exam in 3 to 4 weeks. It's kind of like taking a driver's license test or like a real estate license exam. It is not a credential. It just tells the world that you understand the rules of selling a security.
Yeah, there you go.
And it's a license. So what services does a financial advisor, a financial planner, a fee-only financial planner provide?
You know, it varies by practice, but typically what you're going to find is that we will do financial planning, which we're going to talk about the whole process of financial planning, but it should be a very broad overview of your finances and in-depth discussion on topics that are critical to you. And they're also going to probably help you with your investments, one way or the other.
A broker doesn't even have, doesn't even have to have a high school education.
I don't think they do.
Can
I think they
manage
just
millions of dollars. It's unbelievable. What does a fiduciary mean in the financial services industry?
in the financial services industry, it means that I take on the responsibility of putting your interests ahead of my own. So do I act as a fiduciary? Yes, I do.
Okay. Give you a perfect example. A client comes into Delia and she does a financial plan for him. And there are 3 different mutual funds she can recommend to you. One is a Vanguard fund. One is what we call a load fund, a fund that pays commission, and another fund that pays no commission up front, but there's a commission on the back end. Well, a broker who recommends those, has the choice of those 3 funds, has what's called suitability liability. In other words, would any of those mutual funds be suitable for you? And the answer of that is, Delia?
Could be yes.
Yeah, they
could be from a suitability standpoint.
But from a best interest standpoint?
Yeah, from my perspective, the Vanguard is going to offer the lowest fees, the most efficiency, particularly if all 3 funds invest in the same securities.
And that's the fiduciary answer. So from my point of view, and I think Delia's as well, you want a fiduciary financial advisor. There are so many conflicts when it comes to money.
And I'll tell you, I've had clients call me, and not only do they ask that question, prospects, not only do they ask that question first, some of them have me sign a fiduciary pledge.
So what is the difference? I hear Fisher advisors on radio and TV. We are the fiduciaries. What's the difference between Fisher and someone like yourself, Delia?
Well, Fisher would say that there's not much difference at all.
I would say there's a lot.
Although I've had clients who've worked with Fisher who tell me differently. So without saying that I know much about Fisher itself, I would say that the experience that I've had with clients who've worked with them is that they don't necessarily feel that Fisher is working in their best interests.
I think what happens with Fisher is that they don't get all of the services as far as the planning is concerned.
No, they may not.
They lump a lot of folks together. And that's one of the reasons I think it's really important to understand how many clients the advisor has. You can't have, the typical broker has 3,000 clients.
Yeah.
It's impossible to do financial planning for 3,000 clients.
No, that's way different.
Yeah, so completely
absolutely.
Different model. So here's the financial planning process that ideally we should all go through.
And I hope everybody who's taking this course will do this as you go through the weeks. And I heard a really great analogy that at first I thought didn't fit, but it did. And a woman said, the financial planning process is a lot like using your GPS. And she said, what's the first thing the GPS needs to know? And I thought, well, it needs to know where I'm going because that's how I use it. And she said, no, it really needs to know where you are now. Because if it doesn't know where you are now, it can't take you to where you want to go. And I thought, oh my gosh, that's so perfect for the financial planning process.
Yeah. Yeah.
We need to know where you are right now.
Yeah, when we were at Long Beach State, and meeting with the professors, and then only very few knew their net worth. They had no clue to where they were, and I think that's probably true for many of us.
It
So
really is.
yeah, so for yourself, and the workbook is there. Figure out what is your net worth. It's really important.
I will have people bring me a list of their accounts, and Pete, they never add them up. And I'm like, wait a minute, why didn't you add this up? So we need to know where you are now, what you own, what you owe, and really important, we need to know what you want to accomplish and what your priorities are. Because if there's one thing we've all learned, is that life creates changes. Every day you think you know what the day is going to be like, but something comes up. So you have to have priorities among your goals, and you have to be willing to, have to know how you can adapt and adjust.
So you have to have some goals with a dollar value.
A dollar amount and a time frame.
Yeah.
If you tell a financial planner, I want to retire comfortably, and you don't tell them a dollar amount and a time frame, I mean, I haven't heard you yet. I want to retire comfortably. And I'm looking around saying, did somebody talk to me? And if they say, oh, I want to retire when I turn 65 with $5,000 a month coming from my portfolio, now I've heard you.
Don and I were at a program last night, and the presenter was talking about The Millionaire Next Door.
That's a good book.
It is an excellent book, and I guess the author has died, but he did put a supplement together. But he was talking about somebody who has lots of money, but still very frugal. Had a 6-7-year-old car, didn't have the big hat, as he called it.
They called it big hat, no cattle.
Yeah, exactly. And so, it's many of us are that way. And so, but we got to kind of, money is to be used intelligently.
Yes.
And,
we don't
it's
want to
hard.
run out of it.
Yeah.
That's the scary part.
That's the biggest fear that people have, is running out of money.
Understandable.
Analyze current course of action and potential alternatives. What does that mean?
Well, we try to figure out how we're going to meet your goals. If you want to retire in 5 years, how are we going to get there? And
how much to save? Is that kind of what you're talking about?
It could mean how much do you need to save? It could mean how much does your money need to grow to get you there? Maybe you have a lot more money than we think, and it won't take that much to get there based on very conservative investments. Or maybe you have to play catch up and save a lot more and put in your extra amount in your 401ks so that we can get you where you want to go.
Yeah. Or in this market is don't sell.
Don't sell. Yeah, because you might miss out on the 5 best days.
Yeah.
And then we put together the financial planning recommendations. We present the plan. We make it happen, which may mean that I send you to your attorney to get a good estate plan together, a will and a trust. Maybe it means that we can have you consult your insurance person so you get the proper auto and homeowners and personal liability insurance. And maybe it means that we put together some accounts for you. Maybe we open up that Roth IRA. Maybe we make sure your kids have a college plan, like a 529 plan.
When you make a trade on behalf of your client, who is your custodian, and what does it mean? What does a custodian mean?
When I am working with a client to manage their money, the money is not at the Delia Fernandez brokerage firm. It is at an independent brokerage firm, and
you're not connected to Madoff at all.
Not connected to Bernie Madoff, who said he had a brokerage firm, and it was really his pocket.
Yeah.
And so it's at TD Ameritrade. It's a fee-only planner is going to use a separate company custodian to custody your money, to have custody of your money.
Fidelity, Schwab, TD Ameritrade, those are the firms that.
Shareholder Services, which isn't as well known on the retail side.
Yeah.
Those are companies where you can go directly and look at your money all day long, every single day, and they're the ones who send you statements about your account. It's
Are they
very
completely independent from you?
absolutely independent. My client could call up TD Ameritrade any day of the week and say, yeah, we don't want her anymore. Get her out of there, because I have a limited power of attorney on a client's account. I can see their account. I can buy and sell inside their account. And if they allow me to, I can bill my fees to their account, although they may not. They may want me to send them an invoice and write me a check. That's okay. But it is their money, separate account. I can't even go in and update their address or phone number or email, because you could see that could be a security risk, right? Only the client should be able to do that.
Right. And so if I wanted to fire you as my financial advisor, all I have to do is call the brokerage firm.
Yeah, you don't even have to talk to me.
Okay. Keep
Yeah.
that in mind, Delia.
I will. And then once we put in the planning recommendations, the important thing is to monitor the plan and update it or adjust it as we need to.
Okay.
So if you think about your GPS analogy, we need to know where you're starting, how much you have, how much you own and owe, where you want to go. We need to start the plan to see if we can get you to go where you need to go. And then, and we know how the GPS says this, if we run into any difficulties or roadblocks, then we recalculate. And then we monitor and adjust as we go. And then if we find out we wind up where we wanted to get there, then we're really happy, wherever place was our destination. And then we put in our next destination.
It seems like a really an arduous process to put a financial plan together. How do you charge separately for that? Or I know you've been doing it for many years, so you probably have figured out to get some shortcuts in, but is there an extra charge to do an financial plan?
Well, if a client comes to me and says, absolutely positively, you've got to invest my money, I still want to do their planning for them.
Okay.
But a lot of times people are going to come to me hourly and they're going to say, I'm perfectly happy with my Vanguard accounts. I do this myself, but I'd like to have you do the projections for my financial plan.
Because when you do everything and you put all the numbers into the financial planning software, you can do a lot of what ifs.
It's fun. It's fun. I had one client, when I introduced them to the software that they can work with themselves, she said, you introduced it to us and I never saw my husband again the whole weekend.
Let's go to the next slide.
So funny.
Don, I'm going to depend on you to keep track of our time. So how are we doing? And
40 minutes.
30 minutes. Okay.
40. 4 hours, 40 minutes.
Okay, great.
So here's what I hope everybody will consider doing for themselves is putting together what you own, your assets, what you owe, which are your liabilities. You subtract what you owe from what you own, and you come up with a net worth.
And you should do that at least annually,
Yeah,
or once every 2 years.
exactly. And if anything changes, so people will come to me and, unfortunately, maybe a parent died or somebody died. They're coming into a small inheritance or a big inheritance. And I'm like, well, you need to know this right away on your net worth statement and call your auto and homeowners insurance agent, because that money is essentially going to be yours, your share of that inheritance. You need to update that net worth statement.
Yeah. And we've had an immense rise in real estate in the last year.
Amazing.
And so, I see the residents. Do you consider the residents a financial asset for you to work with, or talk a little bit about that?
The asset that we have in our home, the net worth that a lot of people, when they have their home over the years, comes a really eye-popping number, particularly if they've been able to pay down a good part of their mortgage. For my middle-class clients, which is who I work with, for the majority of them, that's money that might be used for long-term care. We try to look at the debt and see if, in the old days, if we could refinance it to a better interest rate. That's probably not happening today. We also take a look at it to make sure that your house is properly insured, because that's going to be one of your biggest assets.
So
and I don't want a bad guy to take it.
Umbrella policy, is that something?
Absolutely. An umbrella policy is an additional an additional liability policy that goes over the top of your auto and homeowners policy. And it is what insurance industry does to provide you with additional insurance. Do you need it over the car? Do you need it over the home? It's sold in $1 million increments.
And it's
Really
very inexpensive.
very inexpensive, you know.
While we're talking about residences, because we don't cover this at all in the sessions, what are your thoughts on reverse mortgages?
For some people, if they really need it, it might be just the right thing to give them support in their older age. If it's a home that it looks like they can live in for the rest of their life, it can be a forever home. It's not going to be the best thing for one of those homes with lots of stairs and you've already got knee problems. Is that really going to be a good idea to try to do a reverse mortgage to eat up all the equity in your house just to stay in the house? It would be better to sell it. But I've had clients do reverse mortgages and it's been great for them.
Okay.
It's enabled them to stay in their home and live comfortably in retirement. And that's a loan that you don't have to repay on your house until you're out of the house.
But if we just have a client right now who needs to go into a board and care because she has suffered a major stroke and she's suffering from dementia, the house has to be sold.
Yeah.
There's a lot of downsides. So go to someone, if you're considering a reverse mortgage, go to somebody who is a fee-only financial advisor and have them run the numbers for you to make sure that it is the right fit for you. It's sold much more like hey, I'm going to go on vacation and I need some extra money. It's not a great idea.
No. And I've actually I'm sorry, go ahead, Don.
Before we leave this page, I just want to make sure you talk about your fees are based on under management. So if I'm looking at this financial statement, if this was the situation, your fees would basically be roughly against the 300,000, not the 1,166,000.
Those are the only accounts that I could really manage. And
okay,
if the client
just want to make sure
that
both. Oh my God, it's against the whole thing. No, it's only against the invested assets.
That's correct.
Not the total net worth. Okay.
That's correct.
Thank you.
But I've actually had a reverse mortgage agent tell me that a reverse mortgage was not a good idea for a widow. Because she had a whole bunch of stairs, her knees were giving her trouble, and he says she's gonna eat up all that equity and then need to move in 10 years, and she won't have anything when she sells the house.
Okay, I consider it a last resort.
Yeah.
Don't let a salesperson talk you into it.
So here's what we also want to think about in these days. You know, the good news is if the Fed is raising rates, you might be getting more on your savings. So keep an eye on online savings accounts. They may be paying you more like 2%, where your bank pays you, less than 1/10 of that. If you go to a brokerage firm, you might be able to get what we call brokered CDs. Now, this is a brokerage account that you could have at Vanguard. You could have at Schwab, you could have at TD Ameritrade. Through that brokerage firm, they may be able to buy you instruct them to buy certificates of deposit that in the middle of September, we're paying almost 3.5%. US Treasury bonds today are paying more like 4%. 4% for 1 year, and you're not going to get that out of your bank. And then I have to tell everybody that there's something that you can buy directly from the government at treasurydirect.gov that's called an I-bond.
That's an eye-popping number, 9.62.
It's only for 6 months. So I believe I've got a separate slide on I-bonds. You go directly to treasurydirect.gov. You can only buy 10,000 a year per tax ID number, social security number. So one for you, maybe one for your partner or spouse, maybe one for each of your kids. You can buy another 5,000 either as a person or a couple if you're married filing jointly through a tax refund. You have to file IRS form 8888. And then they send you an assortment pack of paper I-bonds. You have to hold this for 5 years for full interest. You sacrifice 3 months of interest if you redeem sooner, and the soonest you can redeem is 1 year. The next interest rate change, it changes May 1st and November 1st. We think because of the current high interest rates, you could be getting a good 7 or 8% for the next 6 months. This is a great idea. It's a great idea.
Just got to jump through a few hoops.
Yeah, oh my gosh, yes. And you can also buy treasury bonds, the US Treasury bond, you can buy through treasurydirect.gov. It's just a little different process. You're buying through an auction process. You don't quite know what you're going to get, just a little different. But it's certainly something you can do yourself, and it's worth going out and finding out about it, because everybody's scrambling to find more money for their money. So tax planning. Now, this is why we want to know what your tax profile is. If I'm going to invest your money and it's money that's outside of a retirement account, I need to know what's going to happen if I invest some of your money. Am I going to create a tax liability for you? So you need to know, where are you in terms of your taxes? Are you taking a standard deduction? Or are you itemizing? What's your tax bracket? Pete, I know that's a big one that you love to talk about.
Well,
And
yeah,
what's your taxable income?
yeah, it's, you know, just because something is tax-free or tax deductible doesn't mean it's a good idea.
Yeah,
Everybody's fearful of taxes. My wife is a CPA. She's had clients saying to her, hey, I don't want to earn any more money this year because then I have to pay more taxes. So there's a line in that we use is, don't let the tax tail wag the investment dog.
yeah.
But you really need to understand your income tax bracket. And what does that mean, Delia?
Well, that means that there is a rate at which, kind of a marginal tax rate. So we're looking at this table for a married couple. And let's say that couple makes money between 20,550 of gross income to 83,550 of income. They would be in the 12% marginal tax bracket. Their tax would be 2,055 plus 12% of any amount over that 83,550.
So it's not an additional 12%. It's
No,
just an additional 2%.
that's exactly right, on that increment, on
Yeah.
that increment. And so we call that column of 10% and 12% and 22 and 24, we call that your marginal tax bracket, because it's just that on the margin. I care about that because if I have a taxable account I'm managing, how much, if I bring in an extra dollar that puts you into the next tax bracket, how's that going to be taxed? That's what I care about.
Just to be clear, I think I may have misunderstood you or I misheard it. So if I'm between 20,550 and 83,000, I'm going to pay 2,055 plus 12% over the 20,550, not the
Right.
83.
That's correct.
Okay.
That's correct.
Just wanna make
So,
sure
and
I-
that shows that on that column
Right,
of the
yeah,
amount
okay.
over the 20,550. Thank you.
Okay,
Don.
right, thank you.
Yeah, exactly.
And this is the ordinary income tax rate.
Plain old ordinary.
So we got another kind of tax rate.
So we've got a really more favorable federal tax rate, not California. California considers everything ordinary taxes. They don't give us a break on that. They don't tax Social Security earnings, one of 13 states that does not. But here, if you have either stock dividends that are considered qualified dividends and long-term capital gains, something that you've owned for 12 months, more than 12 months, and you sell, then depending on where you are in terms of income, you might not have to pay tax on those gains. Or you
So-
may pay very little, like 15% tax on those gains.
So it's really gone up. So you can, as a married couple, you can have $83,000 of capital gain income and not pay any tax on that.
If your total income falls into that category, which is a huge, that up to 83,350, that's a nice place to be to
So
sell
if-
stock.
So if somebody's putting their portfolio together, they need to look at capital gain income, not ordinary income.
Yeah, they do need to seriously consider that. They need to take a look at their dividend income. They need to look at potential capital gains income. And if they need to raise some money out of that account, you know, you could sell at a loss. That's kind of making lemonade out of lemons this year, but you might also be able to sell some things at a gain and wind up not paying any tax at all. If you sell some at a gain and some at a loss, they may offset each other.
So this period of time between now and the end of the year, you're looking at your clients' portfolios and seeing if you can do some buying and selling to increase the cost basis for your clients. In other words, do some what they call tax harvesting.
Yeah, tax loss harvesting. And another example is I had a client who owned a business that she sold. So she's got a big capital gain. The good news, bad news is she has a big Vanguard account with a lot of losses we could take. And her accountant and I are talking about how she needs to sell some things at a loss to offset that gain from the sale of the business so that we can get that tax down to about zero.
Yeah. And the other thing too is that most of us who are 65 and older fall into the standard ordinary income tax rates. So if you go back to the other slide.
Yeah.
So, you know,
I don't think I had the standard deduction up here. I have gift tax, but I don't have the standard deduction.
Okay. Most of us are going to be subject to the standard deduction, and they're being increased based on the CPI inflation rate.
And you need to take a look at your tax return, because people will come in and say, well, I could pay off my mortgage, but I want the interest deduction. Well, they're thinking under the old plan, because I'll open up their tax return. They're taking the standard deduction. They don't have enough to deduct in order to make use of that mortgage interest deduction. And they don't realize it because they haven't looked at their tax return.
Are there any major tax changes on the horizon that you see happening?
Yeah, well, we've got, let's see. So we're looking that we're going to have probably the biggest Social Security benefits increase this year that we've had in 40 years. They determine it based on July, August, and September numbers. So we're thinking we might get a good 8 or 9.6% increase in Social Security. That's not quite taxes, but that's a nice message. You may also have heard yesterday that they've decided to lower Part B of Medicare, lower Medicare by $5, about $5 a month for next year. So you're actually going to have $5 more every month in your pocket. I know, not a lot, but we could see a huge increase in Social Security benefits.
Yeah. Well, that'll kind of make up for the amount that we're paying more at the grocery store and in gases.
Exactly.
So for us in California income tax, I have friends moving out of California just because of the income tax issue here in California. You said Social Security is not taxed.
That's correct. We are one of 13 states that do not tax Social Security.
How about pension plans? Are pension plans taxed?
Pension plans are taxed.
Okay.
Pension plans are taxed.
Okay. And the range is for California income. By the way, you said there's no capital gain. So if you're to
sell, there's no special treatment of capital gains. That's correct.
So if you sell your house, for example, you will be subject to California income tax.
Well, if you sell your house and you have a gain of over $250,000 per person.
Okay.
Now, it has to be your primary residence, 2 out of the last 5 years.
So people should look before they sell an asset to see what the tax consequences of that sale is. Whether it's a stock, whether it's a house, whether it's a rental property, etc. Understand the tax issues before you sell, and there might be some alternatives. And charitable alternatives in there become huge when there is a major capital gain.
You know, I tell people that all the time, especially when they have rental properties with a really low initial cost basis. And they say, I've got so much in profits, I'm going to be eaten up by taxes. And I say, okay, this may sound really strange, but I want you to think about a charitable gift of that property. Yeah. And they think I'm nuts.
Yeah.
They think I'm nuts.
You got to run the numbers.
You have to run the numbers.
Yeah. Don't let the word charity influence you. Sometimes the economic benefit can be greater than the amount that you're actually giving. But
if they think about what they're going to have to pay in taxes, exactly.
Their government encourages that, and with the income tax rates and with the appreciation in some of the assets, it could be a very good alternative. But again,
Absolutely.
do you sit down with your client and say, this is the way it needs to be as to going forward?
No, because I think in most cases, I can't do that unless I'm telling them, let's not run up credit card bills at double-digit interest rates that you can't pay off.
Well,
Obviously,
it's not, first of all, it's your client's money. It's not your money.
it's their money. It's
So
their money.
you lay out advantages, disadvantages, go over the alternatives. They make the final choice.
That's right. It's just like my dentist, if I need a cap, should it be porcelain? Should it be gold? Is it my front tooth? Should it be gold with a diamond in the middle? We have to just think about the alternatives and what would be right and not right.
Okay.
I don't want the gold front tooth with a diamond in the middle.
Let's go to your next slide.
Okay, so a lot of us don't have to worry about having too much money when it comes to estate taxes right now. We could each die with $60,000, and we would not be subject to estate tax on our estate except for over that amount. But it can get very complicated if you are worth more than that.
And then that may change in the near future in the 2024 or 2025. I can't remember.
Yeah, 2025 when the Tax Cuts and Jobs Act sunsets.
Okay.
And we can all give away $16,000 this year without having to file any kind of gift tax return.
Can give more without paying a tax. It just
That's right.
We just don't have to we would have to file a gift tax return if we gave more than $16,000 per person per spouse.
That's exactly it. So we need to keep that in mind.
Do you help people make gifts?
I do. I'm a big fan of making gifts to charity. In particular, we were just talking about the tax advantages of making sure you plan correctly with a taxable account. I have a client, we regularly give money, his temple dues every year, we give them highly appreciated stock.
Yeah.
So
And
just do the paperwork to do that.
And the huge thing today is that to give it from their IRA account.
I love that. And it's only IRAs right now, but the qualified charitable distributions, the money comes directly out of the IRA. You have to be 70 and a half.
Yeah.
But
we're going to go through that later, but just keep it in mind. That's where to take the gift if you have it.
And we have to remember too, that for people who are taking required minimum distributions on their own retirement accounts, that the government has adjusted these tables. This is one of those tables, so that we're taking out about 7% less. They've extended the life expectancy, which in essence has changed the formulas for everybody, so that we're having to take out a little less, because there's nothing that makes somebody cranky than having to take out required minimum distributions, pay taxes on it, and it's money that they don't really need.
Yeah, we just a plug. We have the It's Your Estate program on tomorrow, Fridays. And in the It's Your Estate program, we have an entire hour and a half just on retirement plans.
Nice.
Recommend highly if anyone has a large retirement plan, such as an IRA, to watch that particular session.
Nice. So as we've been talking, we need to look at total return. We need to look at what you're getting in dividends and interest. We need to look at how much your individual investments are appreciating so that you can consider and appreciate your total return that you're getting. Some people feel so adverse to any kind of tax that they want California double tax-free municipal bonds, but maybe they're not in the right tax bracket for that. And there are some actively managed mutual funds. That's a whole mouthful, but mutual funds that are generating a lot of activity that really can cause a big taxable event in your account. Those need to be really located in retirement accounts. And then another favorite of Pete's is we need to be really careful of annuities, because they could be the most tax inefficient investment that would be available to you.
For most people,
For most people.
everyone, annuities are the least favorable type of investment vehicle. And the annuity market are billions of dollars are sold. Yeah. I just had a couple that have 12 different annuities. Even their own insurance company called me up and asked, whether or not some undue influence was being exerted for one individual to have these many annuities. And by the way, we are talking here about commercial annuities. They're just very difficult to understand. Many pages. We're not talking about a charitable gift annuity, which is 2 pages long, and any 90-year-old can understand them. So
Exactly.
make sure that when we say beware of annuities, think twice. Let's go to the next slide.
So, and in general, when I mentioned that mutual fund issue in a taxable account, that could be an active investing philosophy. Active says, I'm going to be buying and selling because I'm trying to beat the market, whereas passive says, we really don't believe you can beat the market, so you should just buy the market. An active investment is typically going to be more expensive. It'll have higher trading costs and management.
Fisher Investments is an active firm. Just to give you an idea, or do you consider yourself active or passive?
No, I like to use I use passive strategies, meaning that they are low cost, broad-based, typically broad-based index funds. There might be a balanced fund in there every now and then. But I try to keep my fees down for my clients, and I try to remember that if we did have anything active, it's got to go in a retirement account. It can't go in a taxable account because they can kick out capital gains, even though the client didn't sell anything. Yeah. So passive is buy and hold, typically using index funds. And really that philosophy is if you can't beat the market, you buy the market. And that's John Bogle, who started Vanguard. That was his philosophy. It's
also more tax efficient.
That's exactly right. Not only low cost alternative, but more tax efficient.
Yeah. Hard to beat the market.
Yeah.
Go ahead.
Well, I was just going to say that we also have to think about the end result of all of your investing, which is in retirement. You will take money out of your retirement accounts. If you got a tax break putting the money in, you're going to be taxed when you take it out. And California doesn't tax Social Security. California municipal bonds are usually both tax-free, but most people have the majority of their money in a retirement account. And if they started quite some time ago, they might only have had the option to do tax deferred, where you get a tax break putting money in, but then you get taxed when the money comes out.
It's amazing how complicated money is. And also when you put in the emotions of running out of money, paying taxes, paying medical bills, and you get to be 80 and 90. We've got more 100-year-olds today than we ever have.
Yes. The good news is we're living longer, and the bad news is we're living longer.
Yeah. So I encourage people, if you don't want to hire a fee-only fiduciary advisor today, keep their Ask First forms, and maybe down the road later on, you can, they have your best interest at heart, and they can help you weather that storm, whether, it's all of a sudden your kids are coming after you wanting to borrow money, or how to do the bill paying, et cetera, et cetera. From my point of view,
wow, that actually worked. He stopped. Delia, I don't know how many more slides you have. You have 15 minutes.
Thank you.
You're welcome.
Yeah. To me, the fee-only advisor is a godsend to seniors, and to prevent financial abuse, and to be somewhat more rational with your money.
Actually, I have clients.
It's not your money, and so you're not emotionally involved.
No, I'm not. And I have clients come to me a lot to help their parents. They'll call me and the parents want some help, and maybe dad's not in charge anymore because he's not as capable, but they're seeing some charges come up on credit cards that they don't know what they are. And so we're trying to figure out what's going on, and we want to make sure that they have the documents in place and the team in place to help this couple. if, health goes south and then they need to step in and take care of their parents.
Yeah, I even have given my son, as a recommendation to a family planner to help him determine how much should he put away on a monthly basis. And should he put it into a Roth IRA account, or should he put it into a regular IRA account? And so that he begins to understand the magic of compounding. And what is that?
The magic of compounding is when your money starts making money for you. There's two ways to make money. You can go out and earn it, and that's, every hour, every day that you work, you get paid. Or how about your money just gets bigger and bigger and bigger while you're asleep? Your money grows and you're not having to work to make that money grow. You're adding to the account, but over time, and sometimes it just seems like nothing's going to happen, but it's like a snowball going down a hill. The snowball gains more snow and gains more snow and gets bigger and bigger, and suddenly it is huge. Yeah. The wonders of compounding.
Delia, you may have I don't know the answer to this question. The question that's come up is, can I put RMD money into a Roth IRA? I'm retired and have no earned income.
No, if you have no earned income, you cannot contribute to any kind of retirement account. You can convert. You can take a retirement account, crack it open to a certain degree, take out $10,000, pay the taxes, and convert it to a Roth. But if you are not having any more earned income, you're done contributing to any kind of retirement account.
So she should look at conversion.
Right.
If you wanted to put money in a Roth, but I imagine they want to put it in a Roth to avoid taxes eventually. If you convert to put some money in a Roth, you have to pay the taxes now on the money that you take out of a regular retirement account.
And incidentally, the RMD you have to pay tax on also.
And you have to pay taxes on the RMD as well. And if you're giving money to charity, do it out of the IRA.
There you go. QCD.
QCD.
A little over 10 minutes. Sure. Bye.
Okay.
So we talk, and you're going to cover this in your financial planning sessions, but the kind of money, rate of return you would need your money to grow, to get larger and larger, to sustain certain pre-tax expenses. So we need to know who you are now when we do retirement planning, to figure out who you're going to need to be in the future, how much money you need to have in the future, and how much risk we need to take to grow that account in order to reach your goals.
A lot of people think that, hey, I'm 70 years old, it's too late to change. But your life expectancy here in Orange County is in your mid-90s.
Yeah, the more money you have, the more likely it is that you're going to live longer.
So,
you have better health care, better care overall, better food.
Yeah, so it's not too late to make a change.
No, it's not too late. And it's never too late to know where you are financially.
Yeah.
It's never too late. So here's what we need to know. The normal retirement age is now, if you were born between 43 and 54, normal retirement age is 66. But if you were born after 1959, full retirement age, normal or full retirement age for Social Security is 67. But if every year that you wait after that, your benefit grows 8% a year. So if you can, and if you think you're going to live a normal life expectancy and can otherwise afford it, waiting until age 70 would be great for your Social Security benefit. And you're going to have more time to talk about Social Security in another session.
Yeah. Well, what do you think about the when people say, oh, Social Security is not going to be around?
I want to see a politician who's willing to go into a room of their constituents who are all retired on Social Security and tell them, I'm stopping your Social Security.
Yeah.
Not going to happen.
Not going to happen.
Not going to happen. That's all.
And this goes to a bigger issue. The biggest motivator to get people to buy something or to do something is fear.
Yeah.
If I scare the hell out of you, you're more than likely to make a change in your behavior.
Yeah, when I went into this business, somebody said, now he was a sales guy. He said, there's two great ways to sell, greed and fear. And he says, fear works best.
Yeah. Yeah. So anyone who starts scaring you in the investment world, please, tell them to go away.
Yeah, there's a
You
lot
know,
of people who are trying to scare
Good.
people today.
Fear is good in a sense that it makes you aware,
Yes.
but wait 24 hours, talk to other people. Don't act on the fear immediately.
No, and people make me crazy when they say I'm going to take Social Security early because I can grow and invest it. Well, they felt that way until January when the market started going down. But you have to pay federal taxes on that money. And then if you take it before your full retirement age, you're missing a 7% natural increase. And you take that money, you pay taxes on it, more than 7%, I'm sure. And then you try to make up that amount. You have to make a lot in the market over a long period of time to make up that money that you took early.
I find that my male friends take retirement or their Social Security early. And when I ask them why, they said, "Oh, I probably won't live that long." And well, there's a kind of an average that men do die earlier than women generally, but that's changing.
Yeah.
You
And they
know?
say married men live longer, right?
They do.
Or it just feels like longer. Is that the joke? Sorry. So today in 2022, at full retirement age, if you'd paid into Social Security your entire career, you would get $3,345 a month. But if you waited until age 70, it would be more like $4,194.
And then you got the increase coming. So.
Yes, we're really hoping that we're going to get that big increase, 8 to 9% maybe, and it could be even higher. So that's pretty exciting.
Yeah, dude. The thing of it is I remember the days when you were getting 12 to 14% on your CDs, and but the mortgage rates were higher. Everything stays kind of in balance. So.
Yes.
It's nice to see that Social Security to reflect the rise in inflation. So it's really a good thing.
The one source of income for retirees if they don't have a government pension that adjusts with inflation.
Yeah.
You may not feel like you're ahead, but it adjusts. And then as a lot of people who are getting Social Security may know that a portion of that could be considered taxable on the federal level, depending on where your total income is, your combined income. So it could cause up to 85% of your Social Security benefit to fall under your taxable income category, which means at least 15% of your Social Security is always going to be tax-free.
Okay.
So just keep that in mind. And then we've talked about how financial planners are paid. We've talked about their credentials, and I want you to know that there's a group of fee-only personal financial advisors called NAFA, the National Association of Personal Financial Advisors. There are other associations, but this is kind of the flagship group.
Yeah, I find that if somebody asks me about seeking a financial advisor in another state or in the country, the first place I go to is NAPFA.
Yeah.
And I find that there's maybe, what is the membership level now of NAPFA?
I think it's it might be about 3,000 people across the country, might be 4.
Yeah. But these individuals are fee only. They provide financial planning services besides investment management. And they adhere to a stricter code of ethics, I believe.
Very high standards, but it's like we said before, you have to contact a potential advisor and see if it's a good fit for you. Because if you're just looking for planning, nowadays some advisors are saying, I do planning, but I need to have assets under management to make that happen.
Yeah.
So you need to make sure that that you're talking to the right group.
Yeah. Don, why don't you come back on? And
yeah, we're on the last slide, Don. You've done a good job.
And then, if anybody has a question about
Delia, if you want to stop sharing your screen. Because this way
There
Pete's
I
picture is
am.
bigger.
Well, that's
Now,
what we
there-
want.
Yeah, that's it. There's a question that just came up, actually, and
Sure.
I believe I know the answer, but I'm going to let you do it. Can I take Social Security early? Then at 70 years old, pay back the money and get the higher rate as if I waited until 70?
No.
Two. Can't you give it back within the year, 1 year?
So within, yeah, but you're going to take it early means before your full retirement age. You
Right.
can't wait several years and then pay it back. So if you take it, you start it, and I believe it has to be at your full retirement age, but if you take it and then before 12 months have passed,
Right,
you say,
yeah.
what was I thinking?
Yeah,
And you contact Social Security, you have to repay them, but then you can reset it.
because otherwise, looking at it the way the question was asked, wait, you want to have the money now, and you've got some money and you want to give it to them and immediately earn 8% a year? No, that's, that ain't gonna fly. And that's why
That's under-
I remembered the year. Was
But
payback.
by the
I
way,
remember.
but just to give credit to
thinking.
the person who asked the question, Social Security is not easy to figure out, especially if you have a deceased spouse or you've been remarried, when to take it, because you got so many years as an opportunity. Don't think it is intuitive as to these decisions about Social Security. You need to, there's software out there now to help you calculate when is the best time to take Social Security. But for most of us, if we can afford it, that guarantees 7% for
Eight.
it's 8%, 7 to 8%.
It's, if it's after your full retirement age, which this year is age 67, if you wait between 67 and 70, you're guaranteed an 8% increase plus whatever other cost of living increase they put on
Right.
Social Security.
Yeah.
Which is a huge benefit if you can afford it, you know?
If you can afford
Absolutely.
it, that's the key. And how long do you expect to live? Because you have to
Yeah.
recover the money over time. I mean,
That's
I have
it.
people that go, wait, well, why did you wait? Well,
Hey, do you
Yeah.
ask your clients, Delia, how long do you expect to live?
I do ask them if they expect a normal life expectancy. I mean, I'm not probing. Oh, you look kind of piddly today. Are you in good health? No, I don't
Well, I
say
think it's a
that.
really important question.
Oh,
you know,
no.
if
Oh,
you're,
absolutely.
you know, if you've got, I mean, if you've got a short lifespan, you know, why save? You know,
Yeah.
it's,
I tell them the minute they have some health event that's going to shorten their life, they go file.
you know, one of the things I love about Fiona Advisors is that if a client can afford it, you encourage people to spend. And you know, not wildly, but you know, sometimes people have a bucket list, you know, they have, hey, I have a trip that I want to go on, and or I want to meet with family.
Well,
or
this is something COVID taught us, because my older clients have come in and said, I don't know how much more time I have to do this travel. These shutdowns are killing me. And now they're out traveling. They're having a
Yeah.
great time.
yeah,
so we just had a, yeah, okay. We just had a question asked twice. What does FRA stand for?
Oh, full retirement age. So sometimes Social Security calls it normal retirement age, and sometimes they call it full retirement age.
So
I
67
think
today,
67 is full retirement age.
for most of us, yes,
For
right,
most of us.
okay,
yeah.
thank
And,
you.
you know, that's, and the other thing too that makes this area as difficult is the initials. FINRA, index funds, FRA.
We all have our own jargon, don't we?
Yeah, RIA, you know, and communication makes it really difficult. And how do you help parents or grandparents how to encourage their grandkids or their kids to save?
Oh, yeah, it's a good feeling when somebody says they've opened up a savings account for their child and the child is learning about how their money is growing. Or in today's stock market, if they're investing, they learn about the ups and downs.
Yeah, there's a lot to money. And we haven't even talked about the psychological aspect of money. You know, the whole recency bias. Should people be watching CNBC
You know what?
regularly to learn about money?
I never turn it on. Somebody called me, not realizing they were calling a business, and they said, you know, our investment guy has been on CNBC. Do you watch CNBC? And I said, I don't like my investment advice with sound effects. And he said, he got real quiet. He says, you're in the business, aren't you? And I said, yeah, and he hung up.
Yeah. Yeah. You know, some people like Jim Cramer and
He's,
some of the
you
other-
know, when he used to write articles for certain magazines, he wrote really thoughtful articles, but I don't watch the day-to-day, minute-to-minute news. I just don't.
He's an
Pete laughs at
entertainer.
me. Pete laughs at me because I am the anomaly. I watch it every day at lunch.
Hmm.
Other people get indigestion watching it. I watch
You
it
know,
more for theater and
I-
just what's
Yeah,
going on
that's
at the
fair.
moment.
Exactly.
I
But
do
I'm
Wall
not. I'm
Street
not changing. I'm not
Journal
going to buy or
and
sell
Barron's
something
and-
because of it.
I'm checking the news.
Yeah.
I don't want the sound effects.
Well, I think we're
I think we hit our
close.
time.
Yeah.
One quick question: is it RMD for 2023 73 or not 72? It stays at 72.
Okay, so hold on a second. There's something called a required beginning date. Your required beginning date is April 1st of the year following the year you turn 72. So 72 is the number a lot of people think about as when they have to start, but the drop dead rate date is April 1st of the year following the year you turn 73.
Oh yeah, I don't have to pay it until the end of the first quarter.
You
The
don't
first
have
year.
to, if you took it, if you're 72 this year, you don't have to take it until the end of this year.
However, next year on your income tax, you're going to have two of them, and your tax
Yes.
rate's going to go up because you're in a bracket.
Exactly.
So anyway, it's an
Exactly.
interesting question.
It's
Yes. So since we are on time, this is
Delia, I
the
love you.
Thank you.
financial and estate literacy. It's your money. This is week one. Wonderful overview. The material again is on the website. So go there and pick up the material, go back through what you just heard, get the Ask First form, get the workbook if you'd like to have that. And we will see you next week for the first week of financial planning. Then at the end, there will be a second week of that. And Pete, thank you very much. Dalia, thank you very much. And
If you're signed up for the It's Your Estate program, we'll see you tomorrow. But please make sure you register. And if you want to send or make sure other people in the family or friends or relatives learn about the program, please let them know. We do not advertise. It's all about word of mouth. So,
and these are, as I said earlier on, these are recorded. And so the recording of them will be on that website, same place as the material, within the week. It may be more depending on schedules and whatnot, but that's where we are. And I was a good person, and I did in fact actually record this. Thank you very much. Have a good time. I'm going to turn off the recording.